S&P 500's
S&P 500 index fund.
The S&P 500 is
the S&P 500.
The S&P 500.
The S&P 500.
An S&P 500 low-cost index fund.
Everyone says to invest in the S&P 500, but no one says which one or why. To fix this, I've ranked every single S&P 500 index so that you don't have to. In this video, I'm going to explain why you should invest in an S&P 500 ETF, what makes an ETF good, and which one is the best one for your investments. So stick around. So first off, why should you invest in the S&P 500? In short, it's a stock market catch-all, but better. What do I mean by that though? Let's say you're required to build an all-star basketball team and you have to pick the players. Investing in the stock market as a whole is like picking from every single person that's ever played basketball. You have no idea if they're going to be good or bad. The odds are your team is going to suck. If you pick the S&P 500, it's like picking the NBA. You're taking the best league as a whole rather than everyone as a whole. That's why you want to pick the S&P 500. Okay, so you know you want to pick the S&P 500, but why does it matter which ETF you pick? With the same basketball analogy, would you rather have LeBron James on your team or Jeff Green? If you don't know who Jeff Green is, I've proven my point. So the metrics that make a good ETF are the expense ratio, market cap, tracking error, liquidity, and bid-ask spread. The expense ratio is a small fee you pay each year for owning a fund. It's how the fund makes money. The lower the expense ratio, the better. The market cap is the total value of the ETF. It's like the price tag if you wanted to buy the entire ETF. The higher, the better. The tracking error shows you how much the fund's performance is different from the target it's supposed to follow. A high tracking error is like when you go to a restaurant and sometimes it's good and sometimes it's bad. You want your tracking error to be low so that you know it'll be consistent. You want the food at the restaurant to be consistent. Liquidity is how easy it is to buy or sell something without changing its price too much, like trading $1 for 4 quarters. Low liquidity may mean that you would have to trade $1 for 95 cents. Obviously, you don't want to do that. The bid-ask spread is the small gap between the price buyers want to pay and the price sellers want to sell at. It's like haggling at a flea market. A low bid-ask spread means that you pay the same thing no matter what. The main difference between a bid-ask spread and a flea market is no matter what, you're getting the worst deal in a bid-ask spread. All right, we're back. We're ready to do the tier list. I've got it set up here. As you can see, I'm in the corner, some corner. I'm not too sure. You'll find out, you'll know. Let's just get started. So, first up on the list is John Hancock. Now, I'm not going to lie. This is going in the C tier. This is not a good S&P 500 ETF. The reason for this primarily is the bid-ask spread. It's 0.29. That is not good for an ETF. That is bad. Another reason this is bad, if I come over to my notes over here, is the bid-ask spread. It's not good. It's not good compared to the others on this list. All right, moving on. Number 2, ALPS. This ETF, even worse. It's even worse than the last one. D tier. The reason for this, number 1, the bid-ask spread is not good. Super small market cap as well. This is a very small ETF, which means that it's going to be harder to sell, less liquid, a worse bid-ask spread. You don't want this ETF. You do not want this S&P 500 ETF. Please don't get it. This is not financial advice. None of this in this video is financial advice. You can't sue me. This is not financial advice. Keep that in mind. Not financial advice. Make these decisions on your own. Do more research further than what I say. But if you don't, personally, I'm not liable. Don't forget that. All right, next up on the list after ALPS, we got SPY. So this is one of 3 of Spider's S&P 500 ETFs. Why do they have 3? I don't know, but one of them is much better than the other 2, and one of them is much worse than the other 2. That's all I'm saying. So come up, SPY. This is very popular, a very popular ETF. And let me tell you, it's pretty good. It's a pretty good ETF. B tier. The only thing holding this back is the expense ratio, 1, in the bid-ask spread too. The other three categories, the market cap, the tracking error, and the liquidity, it's the best of them. This is a very popular ETF. It's for a good reason. But the expense ratio is not as good. If someone tells you that this is the best S&P 500 ETF, you can tell them that they're wrong because the expense ratio is bad and the bid-ask spread is not as good as other ETFs. The expense ratio for this is 0.0945. Not the worst, but also not the best, as I'm saying. That's why it's in B tier. Coming up next, SPLG. As you can guess, this is another of Spider's ETFs. That's why it starts with SP, if you're picking up on the pattern. This ETF, also B tier. I'm not gonna lie, SPY is the best of the three. It is. This one is the worst of the three. It's worst. It's the worst one. And the reason for that is because of the bid-ask spread. Garbage bid-ask spread. It's third worst out of all the ETFs on this list. You do not want this ETF if you are wanting to invest in the S&P 500 ETF. If you really want to be under the Spider category, you'd want to go with SPY. Next up on the list is the Wisdom Tree ETF. So this, sorry to say, C tier. Not good. Not very good. You wouldn't want this one. The reason, bad expense ratio, even worse market cap, not very good tracking error, not very good bid-ask spread, not very good liquidity. The bid-ask spread is actually, oh no. The bid-ask spread is almost the best part about it, but it's still not good. It was middle of the pack out of these 16 ETFs. Next up is the X-Trackers ETF. And I'm not going to lie, I'm going to have to add a new row for this one. This is F tier. This is garbage. Don't buy this ETF. This is not financial advice, but this is F tier. This is the worst. I will say it's the smallest, it's the smallest ETF. Second worst bid-ask spread, second worst liquidity, and third worst tracking error. This is a garbage ETF that you do not want if you're trying to invest in that S&P 500, or if you're trying to invest in all, I might as well add. A bad tracking error, the third worst. If you have that tracking error, you don't know what you're getting. You don't know what you're going to be getting with this ETF. You don't want it. But I will say, there is a worse ETF on this list, so keep that in mind. Next up on the list, a nice change of pace, is the iShares Core S&P 500 ETF, ticker symbol IVV. I put the ticker symbols for all the other ones. I forgot to say them, I'm not going to lie. But they're there. You know the ticker symbols. This is A tier. So in this category, it has the best bid-ask spread out of any of the ETFs. And it's pretty good in every other category, but it's not the best. That's why it's not an S tier. There's only one in S tier. This is close to the best though. This is very good. This is very good. Next up on the list is VOO. VOO is Vanguard's S&P 500 ETF. This is my favorite ETF. You may be wondering why. It's because it's the best. It's the best ETF out of all these. It scored the highest overall with all the categories put in. I own this ETF. This is not financial advice. But if I was investing, which I do, I would have this, which I do. So take that for what you will. The S&P 500 ETF, ticker symbol VOO. To put into perspective, out of all the point rankings, this one has 72. The iShares ETF has 71. So do with that information what you will. This also had the best bid-ask spread. It had the second best liquidity score and the second best market cap. So that's kind of what put it ahead of iShares and what will put it ahead of one other ETF that is in the A tier category. You should do research on which of these you want to have as your S&P 500 ETF. You may like the other one more, so you have to stick around. You can't leave yet. Coming up next on the list is the Direxion ETF. I'm not going to put the ticker symbol for this, and I'm not going to say it, because this is by far the worst ETF on this list. Do not get this ETF. It sucks. And it's because it's a bull 3 times ETF. What that means is it's 3 times as volatile, 3 times as stupid. You don't want to get this ETF. It was the worst in bid-ask spread, the worst in liquidity score, the worst in tracking error, and the worst in expense ratio, coming in with an expense ratio of 0.95. That is almost 1% loss. If you put in $100, they take $1. That's horrible. That's so bad. To put into perspective, Vanguard, 0.03. You put in $100, they take 3 cents. You put in $100 here, they take $1. Why would you want that? You don't. It's a bad move. Do not get the CTF. This is not financial advice. Don't get the CTF. All right, next up, the ProShares ETF. It's not good. It's bad. It's not the worst. It's worse than the X-Trackers one. Not as bad as the Direxion ETF. Direxion, I don't know how to pronounce it, and I don't care, and I'll never learn because that ETF sucks. This ETF also sucks. You do not want this. All right, the Pacer Trend Pilot US Large Cap ETF. D tier. This also sucks. You don't want this ETF. Not financial advice. I wouldn't buy it personally. I wouldn't recommend it, even though I don't make recommendations because this is not financial advice. I wouldn't do it. Next up is the Global X Covered Call S&P 500 ETF. If you don't know what a covered call is, don't invest in the ETF. If you do know what a covered call is, don't invest in the ETF. It's C tier. I mean, it's mid. It's worse than mid, actually, because B tier, I would say, is mid. So yeah, you don't want this ETF. All right, coming up next is the Fidelity ETF for the S&P 500, FXIAX. This is a good ETF. It's the second A tier. It's ranked the same as iShares, 71 points overall. This is out of 80 points, by the way, so it's 71 out of 80. Take that for what you will. 72 out of 80 with the Vanguard ETF. So you could argue that this is a very good ETF and you could buy it. I personally like VOO because it's the best out of this ranking system. Two more left. This is all we have. This is Invesco's S&P 500 ETF. Now, Invesco, I think ironically, has a lot of commercials. I see Invesco commercials more than I see any other investment commercials. The reason I say that's ironic is because this ETF sucks. It's not very good. It's C tier. It's only above average in the bid-ask spread and the liquidity score. Everything else, it's below average. Why would you want that? Why would you want that? Why do they pay so much for marketing? Because they're not good. And they just pump all their money into marketing, which would explain why they have such a high expense ratio. They're taking that money and they're putting it in marketing to trick other people into buying this ETF. But you know something that they don't. You know that it sucks. They might know that it sucks compared to the other ones. So that's even worse. Don't buy this ETF. Unless you want to. This is not financial advice. And finally is the Schwab S&P 500 ETF, B tier. It's a little above average. You could get it if you want. I wouldn't recommend it personally. I would want to go with one of the top 3. But that's all I have for you today. Thank you so much for watching. Let me know if you have any of these ETFs. I hope you don't have one of these 3 ETFs or one of these 2 ETFs. If you do, you might want to rethink your decision making. You might want to think about hiring a financial advisor. I'm not one, and I don't think you need one. But if you want one because you've been making decisions to invest in companies like this, you should probably get one. See you later.